So you have a bit of money saved up and you want to start getting involved in this investing thing, but every time you look it up, there seems to be so much information out there. Should you get involved in stocks, bonds, mutual funds, index funds, commodities, futures, options, fine art, real estate, watches? There's so many different things out there that we can invest in, and it can all be so confusing. And you've probably seen a lot of these YouTube ads advertising different platforms where people are making tens of thousands of dollars each day from day trading. Is that a viable option? Could you trade foreign exchange? Could you trade stocks? And on top of all of this, you're petrified of losing all the money that you've worked so hard to accumulate. And so with all that being said, welcome to today's video where we're going to be discussing everything you need to know to begin investing today. My name is Willis. I'm a chartered accountant who's been working in the finance industry for 7 years now, and I've been studying all things money, personal finance and accounting for the past decade. So this video is going to be split up into 4 parts. In part number 1, we're going to be going through what investing is and why it's important. In part number 2, we're going to be discussing the different types of assets that we can be investing in. In part 3, we're going to be going through some of the most common fears of investing, and in part 4, we're going to be taking some advice from arguably the greatest investor of all time, Warren Buffett, around what the greatest investment that we can possibly make is, so make sure you stay tuned for part 4. So what is investing and why is it important? When we accumulate some cash, there's a few different things that we can do with it. We can, of course, spend it. We can hide it under our mattress. We can put it away in the bank, or we can invest it in assets. The main problem with leaving the money under the mattress at home or putting it in the bank is that it tends to get eaten away at by inflation. And if you're not sure what inflation is essentially where the value of our money declines over time. And you'll see this from year to year, where the price of everyday goods that you buy this year will probably be slightly more expensive than they were last year. It's also not uncommon for the rate of inflation to outpace the rate of interest that you'd get keeping your money in the bank. Therefore, it's important to invest any excess cash that we have into assets that are going to increase in value over time and outpace that inflation rate. To put some numbers onto it, $500 today might buy you an iPhone, but in a few years' time, that same iPhone will cost $550. This is the impact of inflation. Now, when we invest our money in assets, there are really 2 ways that we can generate money from those investments. The first is through the general appreciation in value of those assets over time. And the second is any cash flow that those assets are paying us in the meantime whilst they increase in value. So, one of the easiest examples to understand is buying a house. Let's say you buy an investment property. Now, the cash flow that you generate from that investment property will come from the tenants paying you rent. That's the cash flow portion, or the income now. In the background, hopefully, that house will continue to rise in value over time. And therefore, with this investment property, hopefully you're getting cash flow now, but also a capital appreciation for the long term. And so this means that one day when you come to sell that property in the future, you should be able to sell it for a lot more than what you purchased it for. A lot of assets that people hold as investments are typically held for capital appreciation purposes only. And this is largely the case with things like stocks and shares, but some shares can pay you dividends. So what should we be investing in? There are many different types of assets that we can invest in. These are things such as stocks, shares, equities, hedge funds, mutual funds, index funds. These are all share related, and then there's real estate, fine art, watches. The list goes on. When most people refer to investing, what they're referring to is investing in stocks and shares in the stock market. So for the purposes of the rest of this video, that's the area that we're going to be focusing on today. So what is the stock market? Well, this is where publicly traded companies, which tend to be the world's largest companies, sell their shares to the public. Once those shares have been initially sold to the public, they can then be sold between members of the public in what's known as the stock exchange. Whenever you buy a share in a company, you are essentially buying a tiny little piece of that company. And therefore, you are entitled to the percentage ownership that you own in shares of that company's assets and distributable profits. One publicly traded company where you can buy shares in the company is Apple. Now, unfortunately, you can't just go on Apple's website and just buy a share directly from apple.com. You will instead need to go through a broker. And these days, it's typically just an app on your phone. So do some research in your particular region and find one that seems to be the most reputable. Once you buy a share in a company, you're hoping that the value of that share will increase over time. That's the capital appreciation aspect we talked about earlier. The companies may also decide to distribute their profits to the shareholders in the form of dividends. And this is the cash flow aspect. So what are dividends? Well, when a company makes a large amount of profit, they often decide we want to distribute some of our excess profits to our owners, i.e. the shareholders. Now, if you own 10% of, say, Apple, extremely unlikely I know because that would cost absolutely billions, but if you own 10% of Apple and they declared a $1 million dividend, then you would be entitled to 10% of that dividend. And so in this case, you would receive a payment of $100,000. Now, of course, this is not realistic at all. What you're more likely to receive is $10 here, $5 here, $2 here, $3 here from your portfolio of different stocks. So which companies should we be investing in? I mean, there's so many out there. There's Apple, Google, Facebook, Amazon, Tesla, McDonald's, Coke. The list is almost endless. And for some guidance on this, we need to think about what one of the greatest investors of all time, Warren Buffett, has to say about the subject. He says the average person will not know which stocks to buy. They will not know what time to buy them. And therefore, Warren Buffett recommends that the average person does not try to pick stocks. And this message is echoed by many of the greatest investors. They say picking stocks is virtually impossible. Even some of the best investment managers out there today, and some of the greatest investors of all time, they all know nobody knows whether the market is going to go up and down. Warren Buffett, as I mentioned, arguably the greatest investor of all time, he spends at least 5 hours a day just simply reading and analysing financial statements to determine whether the companies that he's invested in or looking to invest in are viable options or are performing well. Now, I don't know about you, but I don't have 5 hours a day to be investing my time into reading company financial statements over and over and over. And I'm probably guessing you don't either. The truth is, unless you're a professional fund manager or investor who does this day in day out and earns their living through investing in individual company stocks, then trying to pick individual stocks for you and me is far too risky, and it's just simply not going to work. Peter Lynch, who's considered one of the greatest investors of his generation as well, once said, if you're right in this business, being investing, 6 out of 10 times, then you're very good. And I don't know about you, but 6 out of 10 times to me doesn't sound that impressive in any other field. Now, luckily for us, there is an alternative. This is known as an index fund. So what is an index fund? Well, an index is a list of companies. For example, the S&P 500, which tracks the largest 500 companies in America. And a fund is simply just a basket of different stocks and shares. So when you put the two together, index fund is a basket of stocks and shares that tracks a specific index. For example, the S&P 500 index fund would be a fund where you can invest your money, and then your money that you've invested in that fund gets evenly distributed throughout the shares in all the companies in the S&P 500. This means if you put $1,000 in, then your $1,000 will be split in terms of what it's invested in based on the percentage of the S&P 500 that each company within that list of 500 companies makes up. So let's say hypothetically Apple makes up 4% of the S&P 500, then 4% of your $1,000 that you've invested in the S&P 500 index fund is now gone to purchase Apple stocks. Therefore, having initiated your investment, you now own around $40 worth of Apple stocks. That's pretty cool, right? Now, one of the benefits of using an index fund is that it tracks the overall index rather than any specific company. So if the index goes up over time, so will your returns. And what this also means is, even if there are a few companies in the index that have not performed very well this year, if the overall index has gone up still, you'll still make a positive return. Index funds also allow instant diversification. Diversification is just a term used to describe when you spread the money that you're investing across a bucket of different items, different stocks, different shares. You can also diversify between different asset classes, so include things like bonds and other assets. And the reason why an index fund provides instant diversification is because of the fact that there are a large number of companies within the index. Taking again, for example, the S&P 500, there are 500 companies in there, so your investment is already instantly split between 500 different companies. Index funds also offer very low fees, and therefore your returns are not diminished too much by the management fees, and they're also extremely low maintenance because they're passively managed. There's no active investment manager managing your portfolio for you, it just simply tracks the index. And another key factor as to why index funds are so good is because most of the time, most investment managers who pick out individual stocks actually can't outperform the index itself. The index fund will perform better than these people who are paid extremely high salaries to pick out individual stocks for their clients. And so not only is it cheaper, but you're actually probably getting a better return. And the overall purpose of investing in an index fund is just to invest with the market and follow the trajectory rather than trying to beat the market, which is extremely hard. And let's put some numbers onto this to show how index funding can work. Let's say you had an initial deposit of $1,000 to invest in an index fund. Let's say you put that into an index fund and were able to contribute an additional $800 per month over a 30-year period. Let's say you achieved a return of, say, 7% on average over this period, which is about right for the historical return of the S&P 500 index. You would have contributed, by the end of this period, $288,000 of your own money. However, your portfolio would now be worth close to $1 million. So what are some of the most common fears around investing? Well, what if I lose all my money? What if all the stocks and shares that I invest in go down to zero as soon as I invest? And these are legitimate questions and legitimate concerns, so let's have a look at these now. If you were to invest in an index fund, as we just mentioned in the previous section, then you're extremely unlikely to lose all of your money. The reason for this is because, let's say you invested in the S&P 500 index fund. Well, for you to lose every single dollar that you invested in the index fund, that means the top 500 companies in America would have to all fall to zero. What this means is the top 500 companies would have no value whatsoever. And the likelihood of this happening is extremely low. And to be honest, if that did happen, that probably indicates that there are much bigger problems going on than the annual return of our stock portfolios. However, you do need to be aware that the stock market, just like everything else, is cyclical. And therefore, you can expect to see a decline in value of your investment at some point throughout your journey. For example, if you invested just before COVID-19, then you would have seen a very sharp 30% drop when COVID-19 really took off in Q1 2020. However, if you didn't sell your investments and instead you stayed the course, then by now the value of those investments would have increased dramatically, as we can see from the graph. And that's something we have to bear in mind here. Just because the value of your investments has fallen does not mean that you've necessarily made a loss just yet. The loss is not actually locked in until you sell those shares. A simple drop in value of the index is known as a paper loss and not an actual locked-in loss, which, as I mentioned, only occurs when you sell the shares and lock in that loss. Therefore, it's important to just remember to stay the course and not get too emotional about the value of your investments. There's a great book written by John Bogle, who was the founder of Vanguard and really popularized the index fund. It's called, fittingly enough, Stay the Course, and I definitely recommend it if you're concerned about investing in the stock market. Historically, over longer term horizons, the stock market has always increased in value. And the reason for this is because the number of people in the world has increased dramatically. There's more and more people therefore going to work, therefore businesses are making more money. If businesses are making more money, the overall economy goes up. And when the overall economy is up, the stock market is generally up as well. And so as the world continues to develop these new technologies and continues to do more and more business, the value of the stock market is only really going to increase. And so it's highly unlikely that over a long-term period, you would actually lose money investing in something like an index fund tracking the S&P 500. Another common concern is you don't have enough money to begin investing, and that's just simply not true because many platforms these days can allow you to start investing from as little as $100 or maybe even less. And so even if you only have a few $100s saved up, there's nothing stopping you getting started today. Okay, so moving into part 4, what is the greatest investment we can possibly make? Warren Buffett once famously said that the greatest investment you can make is an investment in yourself. Dan Martell says the greatest asset is you and your ability to make money. And Alex Hormozi, he says it's the S&P or the S and me. Now, so far throughout this video, we've been talking about investing in the index funds and the S&P 500, and this is all very long term, and it'll probably take 30 or 40 years for you to really achieve a great amount of wealth. However, if you choose to invest the money that you do earn into courses and education that can improve your skill set, then you may be able to create a business of your own where the amount of money you could earn could far outweigh anything you could ever earn from a job, and therefore allow you to get very rich very quickly. And by very quickly, I mean sort of maybe 10 years. And if you've read The Millionaire Fastlane by MJ DeMarco, you would know that this is known as fast lane wealth. And I think this is a great alternative way of looking at investing because you're not really hoping on the market continuously going up because there's no guarantees. But if you take control of your own development, of your own skills and your own ability to make money, then this may in some instances be a safer bet. And so as some people might say, take the money you earn, use it to acquire skills and information, and this can improve your ability to make money very quickly. I hope you enjoyed this video. If you did, I know you'll love this one, but don't go just yet. Make sure you drop a like on this video and subscribe to the channel. I'll see you over there. Bye.